Hello traders, Gary Wagner here. Just about 11:30 in Honolulu, 5:30 in New York. It is Wednesday, 9th day of January 2019, and this is the Daily Report for Gold and Silver. Nice upside spike in the precious metals complex all across the board, with some real tailwinds from an extremely weak U.S. dollar really being the catalyst to today's change. And we'll talk about that as we look at our technical studies. Gold currently printing at $12.9420. That is basis February's contract. That's up $8.30. Low today was $12.8090 with a high of $12.95. We will be looking to roll over our positions, pull profits on our February contract that we have now, and look at the April and a good entry price. We'll talk about that throughout the rest of the week. Silver gaining about 0.5% on the day, about 8 cents at $15.79. Platinum pretty strong today, up $7.40 at $8.29 and change. And palladium up 0.9% in $11 gain, trading at $1,272.80. As I said, it's really been dollar weakness today that is so prevalent, with the dollar index currently down by 0.8%, a 78-point decline, currently at 94.69. And U.S. equities did trade moderately higher, with gains in the NASDAQ composite of almost a full percentage point, a 60-point gain at 69.57. Standard & Poor's about 0.4%, 25.84. And lastly, the Dow up about 0.4% at 23,879. Traders, a nice and solid upside spike today in gold pricing, and that all due to a weakening U.S. dollar. The U.S. dollar today was weak primarily as minutes were released from last month's FOMC meeting, showing a couple of things. Most importantly, showing that there's a high probability that the Fed is going to relax its pace at which it's been raising interest rates. Realize last year contained a total of 4 rate hikes. That was the most rate hikes in a single calendar year since the Fed ended its quantitative easing and began a monetary policy of quantitative normalization. We currently have gold at $12.9440, puts it up about $8.50. I did send out a special trade alert yesterday recommending that we move our stops up. We are long this market from approximately $12.68 and 13 cents. We had our stop at 70. We now have our stop up at $12.7813, and that was really based upon putting it right below the low that we saw on Friday, because my sense is that we're going to get a tightening of range or an upside spike, and I'm really looking for the market to once again challenge $1,300 per ounce. It only challenged it on one occasion so far this year. I believe the high that particular day, which was Friday, was $1,340, so just a couple of ticks above that. Now we are once again within striking distance of that elusive number. And as I said, I look at current resistance as a band between $1,312 and $1,300. The $1,300 is that key psychological level, whereas the $1,312 is derived from a Fibonacci retracement. The other thing that I find interesting when I look at this market and look at some of the other technical indicators, we've talked about this throughout last week, is the fact that we have a narrowing in terms of the relationship or price points between the short-term 50-day moving average in green and the long-term 200-day moving average in red. If and when, I should say, we get the 50-day crossing above the 200-day, that would create a golden cross, and the strongest of the golden crosses, because realize we've had the first golden cross occur back last year, and it happened when the market itself was trading at roughly $1,220. And it was a cross between the short-term 50-day moving average and longer-term 100-day moving average in blue. I am looking for this market to have that next golden cross, and at that point, we will see the market move back into a more bullish upside move. Now, I believe that we still have market strength in terms of the current trend itself, as evident by today's move. However, we moved back into something that I haven't seen really since the end of November, and that is when we consider how this market came off of the bottom, which was trading at roughly these lows at 1160, we had a price spike, which took us to a level of resistance, in this case, 1217 to 1220. We then had the market move sideways until we had another strong upside spike, a stair step, so to speak. And then we had the market pretty much trade sideways for a period of time as it built a base at this new higher price point. We did get this dip here, but we got a spike and another stair step. But if you notice, when we had the golden cross occur, we had something dramatically change. And that was, we had the rallies in gold be strong rallies. Here we get a small dip, but we don't get any sideways action as we got here, and to some degree here. And so then we went into the strong upside spike, which took us above 1275, which is where I'm looking and deeming current support at. And for the last week or so, we've seen the market once again move sideways. So it appears as though we're moving back into a stair step of sorts as this market challenges 1300. Now, we are along our February contract, and we will look to get out of that. We want to get out of that next week, regardless of what we're doing, meaning whether or not we immediately go into the April contract, meaning a rollover, simultaneously selling and taking profits on the February contract and putting an order in to buy at the market on the April, which will become the most active in about a week to 2 weeks. At that point, pull profits on February, and depending on how the market trades over the remainder of this week and the beginning of next, will determine whether or not we do a rollover, meaning a switch, or if we simply pull profits on our February long gold position. And lastly, traders, I do want to look at the underlying cause of today's solid upside move across the board in precious metals, and that was dollar weakness. Daily candlestick chart of the US dollar index, we can see that the low came close to the 200-day moving average. And if you recall from the beginning of the week, we talked about the fact that on Monday of this week, we saw the first occurrence of the dollar index opening below the 100-day moving average and closing even further below that average. We are now coming in to alignment with the 200-day. And as I said, I still am looking at potential support for the dollar on a technical basis at about 94.50. That's the 200-day moving average, with the next real level of support coming in at approximately 94. That's the 0.38% retracement. And just below that at 93.50 is this particular bottom that occurred in September of last year at 93.50, and those are the three distinct areas that I believe we could see the dollar continue to fall to before finding any kind of support. This has been Gary Wagner, wishing you as always good trading. Maintain your current position and make sure that you did trail your stop up this morning as the market opened. Have a great day. We'll talk to you tomorrow. Bye-bye.